Gormaigat Cahirlach, and I'll be sharing with Chocta Doherty. He's on his way. I want to thank you for the opportunity to speak on the bill. Sinn Féin will not be opposing this bill. The legislation is pretty technical in nature. It does make significant changes to the COVID-19 Credit Guarantee Scheme. This scheme is an important scheme, and the changes in it and the changes to its workings are to be welcomed. I know from speaking with many businesses and their various representative groups that there are issues in the structure and working of the loan scheme. The creation of a COVID-19 Credit Guarantee Scheme on the 1st of May to facilitate banks lending up to €2 billion to SME, primary producers and small mid-cap companies was a welcome development. The figure of €2 billion for SMEs was reported across the media, and SMEs and other businesses saw this as a significant development in helping them to bounce back from the challenge of COVID-19. However, as time went on, the difficulties and the flaws in the scheme became apparent to businesses and to politicians. The proof of the limitations of the scheme are evidenced in the amount of monies loaned out. The amount of loans approved and sanctioned for successful applicants to date under the COVID-19 Credit Guarantee Scheme was just €1,606,000, according to a PQ I received back last week. If just €1.6 million is being loaned out under a scheme with funding of €2 billion, then issues clearly exist. By contrast, in Britain, the amount of £30.9 billion has been approved through the Bounce Back Loan Scheme, which is widely regarded as being much easier and significantly less risky to access. When we spoke with SMEs and others, they immediately pinpointed the limitations of the scheme, and they pointed out what needed to be done to address them. Firstly, there was the portfolio cap. The removal of this cap is very much welcome news. Sinn Féin wrote to your predecessor, Minister Humphreys, and the Minister for Finance on the 13th of May, calling for its removal. We stated in that letter that the removal of the cap remedies the problem of the scheme whereby banks were refusing to lend to small businesses in dire need of affordable credit. The portfolio cap meant that banks saw it as unattractive to loan monies through the scheme to SMEs, and that also resulted in extremely high interest rates when it did lend the money. The removal of this cap should make it easier and more attractive for banks to lend to SMEs. However, this alone will not improve the loan scheme. The interest rates charged on these loans are normal business loan rates from the respective banks, with an additional 0.5% charge because of the government guarantee. Furthermore, the Department of Enterprise, Trade and Employment, which funds the scheme through the guarantee, plays no role in the application or decision-making process, which is fully delegated to the participating lenders. As a result, the loans that are issued are at the respective bank's market interest rate. In other words, as Unite the Union pointed out, the banks that administer the scheme also make the decisions as to whether to issue loans or not based on their own for-profit criteria for loan insurance, not those of a government department that is trying to keep companies afloat during a global pandemic. There is nothing in this scheme that speaks to the pressure that thousands of businesses across the state are under as a result of COVID-19. Businesses themselves have pointed out the flaws, but so too have organisations such as Chartered Accountants Ireland. Chartered Accountants Ireland have highlighted first-hand the problems of business in accessing loans with such high interest rates as this scheme has. They stated in their document, The Next Financial Year, Making Irish Business More Competitive, that the COVID-19 Credit Guarantee Scheme is too onerous and complex to administer, and that the interest rates are too prohibitive. They say that the interest rates charged need to be closer to ECB rates than commercial rates. Sinn Féin have been calling for similar low interest rates for a number of months now. This was included in our letter to the Minister's predecessor and the Minister for Finance on the 13th of May. We've been calling for interest rates capped at 2.5%, with interest rates preferably only being applied to cover the overheads of administering the loan scheme. Low interest rates will encourage SMEs to take up the availability of loans. We have heard at first hand from businesses and their representatives. They've also said that it would be a huge incentive and help if the loans were interest-free and with zero repayments for the first 12 months. This is the standard practice for a lot of the COVID-19 credit guarantee loan schemes across the EU, and it would make a significant difference to the loan scheme here. Government should really be looking at 90 to 100% state guaranteed loans with no repayment paid by business over the first 12 months, and the state covering the cost of interest over that period and severely reduced interest rates thereafter. The enactment of these measures would make the Credit Guarantee Loan Scheme much more attractive to business during this unprecedented and extremely difficult period. What would also make a great difference to the scheme is if the government guarantee for the loans were increased upwards to 90%, with a review of its effectiveness to see if it needs to be increased. This was the trajectory of the loan scheme in Germany. It went from 80% government guarantee with the review to 90% and eventually up to 100%. Reviewing the effectiveness of the scheme and enacting the necessary changes if it is not working is the only way we can be sure that the scheme is meeting the needs of SMEs, micro-businesses and family businesses. We have proposed a loan scheme with these features. It has been shaped for SMEs and micro-businesses by SMEs, small family-run businesses and micro-businesses, and it has drawn on the best aspects of European and international loan schemes. If the government persists with the current scheme, just minus the portfolio cap, then the uptake is not going to increase in any significant way, and the failure of the loan scheme will mean the failure of our SMEs. In advance of the July stimulus, can I raise the issue of debt through loans? So far, supports for SMEs have largely equated to further debt through loans. This is precisely what small and medium businesses are saying they do not want. Further debt won't help SMEs and micro-businesses get back to work, and it won't drive any economic recovery. The Taoiseach has spent the last number of days in Brussels warning against pouring further debt on European states and has instead called for the use of grants to help economies recover from COVID-19. It is essential that the government takes the same approach to the July stimulus and includes a comprehensive grant scheme for SMEs, micro-businesses and self-employed sole traders. Sinn Féin, in our Supporting SMEs and Protecting Jobs plan, called for grants of between €12,000 and €25,000 to be given to affected SMEs and micro-businesses. Alongside this grant system, we also outlined the need for a €5,000 grant scheme for self-employed sole traders who have been adversely affected by COVID-19. Such grant schemes have been successfully rolled out right across the EU and beyond. The grants over loans policy, which the Taoiseach was advocating in Brussels, must be reflected in the government's July stimulus. Loans are essential, especially in the longer term, but as regards to what affects SMEs, micro-businesses and family business they need significant liquidity injections. In addition to injecting significant liquidity into SMEs and micro-businesses, the July stimulus must also reduce non-pay expenses for businesses. A rates waiver and a cut in the VAT rate for tourism and hospitality sector until the end of the year, with built-in extension review mechanisms, would suppress non-payroll expenses and allow some breathing space for affected SMEs and micro-businesses. The central plank of the economic recovery from COVID-19 must be a real commitment to our micro-businesses, our SME sector and our family businesses, as well as a steadfast commitment to workers' rights embedded in legislation and the creation of decent jobs with decent pay and conditions. And I have heard people say that there should be some sort of a link for every shilling that the state gives. There should be some sort of a link to workers' rights. And I would say to those people, workers' rights can't be bought. They shouldn't be bought in this way. But if you give an employer or a business £2,000 on a Monday and you turn around then and you don't renew that grant to them, is it then okay for them not to recognise the union? Workers' rights need to be legislated for, absolutely. But they can't just be linked to schemes in this way, because it is not going to work. In the long run, it is not going to help workers. Some of the most negatively impacted sectors of our economy are also some of those with the lowest pay and the worst conditions for workers. Therefore, the recovery for affected sectors cannot be a reconstitution of the past. As we try to help SMEs and micro-businesses recover from COVID-19, we must also try and rebuild our economy in a different way. The vast majority of our economic base is low wage, low growth and low value added. We have to change that, and the government have to be central to changing that. We must progress to build an economy that is robust, diverse, decent wage, high growth and high value added. We cannot enviously look at the economic bases of Germany or Denmark as a pipe dream that we could never have here. We need to strive for the best aspects of such economies and try to replicate them here on a domestic level. We must also reject the negative aspects of such economies too. We must reject the negative economic policies which exploit workers, stifle growth and deprive governments of tax revenue. Worker and community-owned co-ops offer new ways forward for businesses. So too does investment in social enterprises. These are the areas which should be focused on and encouraged as we move through the COVID-19 recovery. The difficulties our economy and SMEs face are unprecedented, and grant schemes and loans will provide much-needed corporate welfare to businesses. But it is imperative that, as a state, we have a much broader plan for our economy. We need an economy that works for the people. That can be done, and it should be a priority. In conclusion, we will not be opposing this bill. We support the general thrust of it, but we would prefer if the scheme had a greater government-backed guarantee, lower interest rates, as well as a number of other changes. But we can, of course, thrash that out at committee.